got Steve. He's our friend here in San Diego.
Yeah.
Right in our backyard or front yard. Hi, Joe and Al. And Andy. Oh, he throws Andy in as. I bet she typed that in there.
Yeah.
Thank you, Steve. I appreciate it.
Thank
you for recognizing
exactly.
me, even though these guys don't.
Your folks.
You folks.
Oh, I thought he was talking about my parents for a minute. It's going to be like, Steve, my dad died. Ruthie's awesome. You folks continue to be great. Every week the show has something interesting and new. Wow. Well,
That's
thank you,
very
Steve.
nice.
I was wondering if you could share your thoughts on ways to diversify an investment portfolio to bring in the best returns. If you're unable to answer from an investing perspective, maybe you can answer from a tax strategy perspective. Thank you so much, and please keep up the good work. Your answers are always helpful. All right, well, there's a couple different angles we can tackle this.
You bet.
So let's talk about investments, and we'll just talk broad strokes.
Okay.
Okay? And we can get basic, and then we'll get into the weeds just a smidge, just to give Steve some perspective, because it sounds like he is a fan of the show, and he's probably listened to other podcasts and has a probably good keen on the investment world.
Yes. Okay. We're making that assumption.
Yes, we are.
Yes. Okay. Good.
Okay. So, Steve, when you build an overall portfolio, of course, it really depends on the goals that you're trying to accomplish, right? Is it for retirement? Is it for college education? Is it for wealth transfer? Whatever. So that's the first step. But he wants the best returns.
Right.
So you can have the best returns depending on what goal that you're trying to accomplish. If I'm trying to buy a house next year, the best return that I'm going to receive is probably 50 basis points.
Yeah. Cash.
Maybe 1% in a 1-year CD.
That's where it should be.
That's my best return that I'm shooting for, because I don't necessarily want to take on extra risk, because I could lose money and then I need it for that time frame. So I'm going to assume that this is for a longer term goal. So if Steve's shooting for the best returns, then you have to look at, okay, well, what's your time frame in regards to the goal? But I think more importantly, it's like, what target rate of return does Steve need to generate to make sure that he can accomplish the goal? So we believe that you take the least amount of risk possible to try to get that best return. And how do you do that? The answer is somewhat simple, but it's not necessarily easy to implement. Okay? So first thing Steve needs to figure out is how much money he needs in stocks versus bonds. Over time, stocks will produce a higher expected return than bonds because there's more risk in stocks. So let's say it's 60% stocks, 40% bonds. Fair enough? Everyone with me so far?
Yes.
Yep.
Okay.
Yeah.
So then you could say, all right, well, in my bonds, I can choose several different types or flavors of bonds, right? I can just go with plain vanilla, or I could go through a variety of different flavors. See how I'm like doing some analogies here to keep this thing interesting?
Yeah, because you almost lost me before you did the flavor. Now I'm thinking ice cream.
So Steve could go long-term bonds. You're going to get a higher expected rate of return in long-term bonds, not necessarily right now because we have an inverted yield curve, but historically, longer-term bonds will give you a higher expected return because there's more risk. You're lending your money to a company or a corporation or a bank or whatever for a longer period of time. A lot of things can happen, so there's more risk. They got to pay you a little bit more. We believe you don't want to take that type of risk in bonds, so you might want to go short. Shorter-term bonds will give you a higher level of security or safety, but a lower expected rate of return. First decision, how much stocks versus bonds. Second decision now is, how would you like to invest your bonds? You can go long-term, you can go short-term, you can go high, let's say, risk or high credit risk, so like more riskier type companies, or lower risk in regards to the federal government. On your stock side, this is where it gets a little bit more interesting, is that you could just say, all right, well, I want to buy the entire U.S. or the entire global market. And you can buy an index fund, and you would be completely diversified with all different sectors and countries. But it might make sense to break those up. We believe that you want to break them up into different categories. One is large companies, 2 is small companies, and 3 is value, 4 is growth. All right? So over time, you look at how much money do I want in larger companies, big companies that you know the names of, versus really small companies that you never heard of before. The smaller companies that you never heard of before will give you a higher expected rate of return in the stock market than large companies because there's more risk. There's more room to grow. Then there's value companies, lower priced, versus growth companies, higher priced. Which one will give you a higher expected rate of return in the market? Well, the lower priced stocks would. So if you use all of this academic research and study and Nobel Prize winning stuff, right, for lack of a better term, you would use that and say, all right, how do I get the best return? Well, you would tilt your portfolio a little bit more towards stocks. And then in your stock portfolio, you would tilt it a little bit more towards small in value. Over time, no guarantees that hypothetically should give you a best return. What'd that take? 5 minutes to explain
Yes.
modern portfolio theory?
That's pretty good. That was a good answer. Let me add a couple of things.
To tax? You do the tax part.
No, I'm still on investment.
We got 7. We only got 3 minutes to go. All right. Go for it.
So I would also add emerging markets would be another tilt because
And then international. Use that same philosophy with emerging markets and international.
So
Yeah.
still small, large value and growth
Yeah.
in international.
Use that quadrant, if you will, if you can imagine it. Like small companies would be at the bottom, right? Large
Yep.
companies would be at the top, and then you cut it like.
But how much
almost
is that
in
in
half?
your equities?
Well, then you would look at how much risk are you want, right? If you're willing to take on a lot more risk, then you tilt that more towards small value, right? And then you tilt it more towards emerging market small value. If you want the highest expected rate of return, it's emerging market small value,
Yeah, I agree.
right? That's high octane.
It is.
That will give you the best return, but it also give you the worst return in any given
A
year.
lot of volatility.
I got a question.
Yeah.
What about alternatives?
What about them?
What's your recommendation?
Sure. I mean, we have alts in our portfolios. It really depends on what your definition of alternatives. And Al's got still a couple minutes to
Go for
give
it.
his point.
Okay, so let's talk taxes.
Okay.
We can go a little bit longer in this one, by the
Got
way.
it.
Okay, well, let's do it then.
All right.
Because when it comes to taxes, we like to identify 3 different tax pools. And we'll call that tax-free for a Roth IRA. We'll call it taxable, which is a non-retirement account. And then we'll call it tax-deferred, which is a retirement type of account. And the reason we separate those is they're taxed differently. The tax-free, when you take money out of that for retirement, it's tax-free. There's no tax at all. The taxable account is monies that you've already paid tax on. So the only extra taxes that you have to pay is any gains on investments. As long as you held them for at least a year and you sell them, you get a long-term capital gain rate. And those rates are 0%, 15%, and 20%, which are a lot lower than the ordinary income tax rates. Now we switch over to tax deferred. When you take money out of your IRA, your 401k, your 403b, that's all taxed at ordinary income rates. That goes up to as high currently at 37%. So what we try to do when you figure out your diversified portfolio is you put different asset classes in different pools. You put your highest expected returns in the Roth IRA. Those are the ones that you expect to grow the most over time. Like, for example, as Joe, you just mentioned, the smaller companies, the value companies, maybe the emerging markets, they're going to be more volatile, but over the long term, they have a higher expected return, and you want your growth there because you pay less taxes. Then you want your safest investments, like your bonds, for example, that produce interest. You want those in your tax-deferred IRA, 401ks, and things like that, because that you don't necessarily want your highest growth there because you pay higher ordinary income taxes, and then the rest goes into your non-qualified account or your non-retirement account. Now, that's the theoretical answer, but in reality, a lot of people have almost all of their assets in retirement accounts, so you're going to have a whole bunch of things in your retirement accounts. But if you had an even balance, let's just say theoretically, you want your highest expected return in the Roth, tax-free, the lowest expected return in the tax-deferred, IRA, 401k, and what's ever left in the middle goes into your taxable account.
Well, and I think that brings to another point is before you really look at how your portfolio should be established, you need to look at, well, what is the tax implication of what you're trying to do, and where's the money held, right? Because, like you said, most people have all of their money in a retirement account. Well, if I were Steve, now you have to be looking at, well, if that's me, maybe I should be thinking about getting money into a brokerage account that's going to be taxed at a capital gain rate when I need the money in retirement. Maybe it makes sense for me to get money into a Roth IRA or Roth 401k, which is going to be 100% tax-free. So when it comes time for me to take distributions from the overall account, right, I can control my taxes. I can pull enough from my retirement account to keep me in the lowest tax bracket possible. Maybe that's the 12%. But I want more income or more cash. I grab it from the Roth or I grab it from my non-qualified account. I have more income, more cash, but I'm still paying very low in tax. So I think a lot of times we get so wrapped up on what is this best return, but it's not necessarily what you earn, it's what you keep, right? So if you're jamming everything possible into the 401k plan, which is great, however, you might be short-sighted. You might be leaving so much money on the table just because of where income rates are, where we believe that they're going. And if you're getting a tax deduction today because you think tax rates are going to be lower, your tax rate's going to be lower in the future, that's one thing. But most people that listen to the show are savers that want to do a little bit better in their overall financial situation. So I'd be extremely, aware of your tax situation, and I'm really glad that he asked that after it should have been first. Well, what's the best tax strategy?
Yeah,
right?
They go hand in hand.
One last thing too is that in the money that you have in non-retirement accounts, you want to look at that type of investment. So if I have an exchange-traded fund or an index fund, that has very low turnover, so it's not going to kick out a lot of interest and dividends, and it's going to keep it very tax efficient from an investment perspective, where we see sometimes there's actively managed funds, there could be alternatives, there could be different, maybe bonds. They might have corporate bonds in that's kicking out interest. They might have a lot of different CDs, but then their 401k plans is jam-packed full of stocks. You want to be careful, too, of just the interest and dividends that all this stuff kicks out just to keep that thing tight and tax efficient as well.